Most people think the reason they fail in crypto after 30 is because they started too late. That's not true. Two people buy the exact same asset. One builds wealth. The other becomes exit liquidity. And the difference usually has nothing to do with intelligence. Imagine this. You're 45 years old. You wake up one morning in 2032. Bitcoin is everywhere. News anchors are talking about how early investors changed their lives. Your coworkers are discussing their portfolios. Your younger cousin who started investing years ago is financially comfortable. And then you open your own account. You owned crypto. You bought. You sold. You panicked. You chased. You quit. And now you're asking yourself a question that hurts more than losing money. What if I had just done less? Because the uncomfortable truth is this. Most people over 30 do not fail at crypto because they are late. They fail because their life changed. And the behaviors that make you responsible adults often make you terrible crypto investors. Today, I'm going to show you why people over 30 repeatedly lose in crypto, why psychology becomes more dangerous than volatility, and the framework that can stop you from becoming the person funding someone else's profits. But first, you need to understand why age quietly changes the way your brain experiences risk. A 22-year-old losing 50% feels pain. A 45-year-old losing 50% feels retirement pressure. Those are not the same experience. When you're younger, losses feel temporary. After 30, losses feel expensive. Because by then, life becomes compressed. Mortgage payments, children, parents getting older, retirement accounts that suddenly feel too small, college costs, insurance payments, career pressure. Every financial decision starts competing with 10 other responsibilities. This creates what I call responsibility compression. And responsibility compression changes how people invest. Not because they become less intelligent, because they become less emotionally flexible. Here's where this becomes dangerous. Crypto is built on volatility. Your life after 30 is built on stability. Those two systems naturally fight each other. And that conflict creates mistake number one, regret investing. Let me explain. Most people over 30 already believe they missed Bitcoin. Not maybe, they believe it. They remember hearing about it years ago. They remember ignoring it. They remember friends talking about it. And regret quietly builds in the background. Regret is dangerous because it changes behavior. When investors feel behind, they stop asking, what is smart? And start asking, how do I catch up? That single shift destroys portfolios. Because missed Bitcoin often creates a predictable chain reaction. Miss Bitcoin, chase altcoins. Miss altcoins, chase meme coins. Miss meme coins, use leverage. And eventually, the market takes back everything. The investor thinks they lost because crypto is risky. Usually they lost because regret made them impatient. And impatience creates mistake number two, becoming exit liquidity. Here's the pattern almost nobody notices. Most over 30 investors do not enter crypto early. They enter after proof appears. Think about how this usually happens. You ignore crypto for years. Then headlines appear. Coworkers start talking. Your group chats wake up. Your barber owns 3 coins. Suddenly, crypto feels safe. But markets are cruel. The moment things feel safest is often when risk becomes highest. So what happens? People buy during euphoria. Then corrections arrive. Prices drop 30%. Then 40%. Then 60%. And because responsibilities already create stress, they cannot emotionally tolerate the volatility. So they sell. The younger investor sees opportunity. The older, stressed investor sees danger. Same market, different psychology. Two investors can buy the exact same asset and experience completely different outcomes. Let me tell you about Michael and Chris. Both started crypto investing at 38. Both had stable careers. Both invested roughly the same amount. Michael constantly felt behind. He remembered ignoring Bitcoin for years. So he moved aggressively. He chased narratives, bought coins after huge moves, followed influencers, checked prices constantly. During corrections, he panicked because every dollar lost felt connected to retirement. Chris approached it differently. He assumed he was late, then stopped caring. He created rules, fixed monthly investments, limited allocation, ignored daily moves, accepted volatility before investing. 5 years later, Michael had gone through multiple boom and bust cycles with little to show. Chris had dramatically larger holdings despite making fewer decisions. That difference matters because crypto rewards behavior more than intelligence. Now, here's the part most creators skip. People over 30 actually have advantages in crypto. You have more income, more discipline, more patience, more capital. The problem is that most people never use these advantages correctly. So here is the framework. First, stop trying to catch up. There is no catch up. That mindset creates oversized risks. Second, build rules before emotions appear. Decide allocation sizes. Decide exit plans. Decide how you respond to crashes. Create the system before stress arrives. Third, use automation. The more decisions you make, the more mistakes you create. Fourth, accept your life stage. If you have kids, a mortgage, retirement pressure, and responsibilities, invest like someone with responsibilities, not like a 23-year-old influencer. Finally, redefine winning. Most people think winning means becoming rich quickly. For investors over 30, winning usually means avoiding catastrophic mistakes because survival compounds. Now picture yourself 10 years from today. In one version, you're still telling yourself, I should have started earlier. In another version, you stopped trying to recover the past and started building the future. Both versions of you had the same market, the same information, the same opportunity. The difference was psychology. Crypto doesn't become harder after 30. You become different after 30. And if you understand that difference, you stop being exit liquidity and start becoming an investor. Your age is not the disadvantage. Your reactions are.